Hello, everyone. Good afternoon. I'm Irish Grace Villian, and I will be continuing the discussion for the topic Factors that Complicate Capital Investment Analysis and Capital Rationing. So, for this topic, the learning objectives are as follows. We have to describe the impact of income taxes in capital investment analysis, evaluate projects with unequal lives, describe leasing versus capital investment, describe uncertainty, changes in price levels, and qualitative considerations of capital investment analysis. Then we'll define capital rationing and diagram the capital rationing process. So let's start with the factors that complicate capital investment analysis. So in the previous discussions, we have learned the four widely used methods of evaluating capital investment proposals. As managers' decisions are critical to the company, there are other factors they need to consider before making decisions on investment proposals. And these are factors: we have income tax, unequal proposal lives, lease versus capital investment, uncertainty, changes in price levels, and qualitative considerations. Let's start with income tax. How do income tax factors affect investment decisions? Income taxes typically affect both the amount and the timing of cash flows. Examples are the useful lives used for depreciation are usually shorter than the actual useful lives. We also have depreciation for tax purposes, which often differs from depreciation for financial statement purposes. So firms that pay income taxes must consider the impact income tax have on cash flows for long-term investments. Also, the project that is attractive on a before-tax basis may have to be rejected on an after-tax basis. So let's look at this example. Dharma Incorporated estimates that it can save $2,500 a year in cash operating costs for the next 10 years if it buys a special purpose machine at a cost of $10,000. No salvage value is expected. Assume that the income tax rate is 30% and that the after-tax cost of capital or the minimum required rate of return is 10%. So after-tax cash savings can be calculated as follows. Note that the depreciation by the straight line method is $10,000 divided by 10 years equals $1,000 per year. So here, before tax cash savings is equal to $2,500. However, we are going to consider tax. So after tax cash savings will be computed as follows, and we'll get a tax savings of $2,050, which is different from that of $2,500 cash savings before tax. So there's a big difference. And also, if we would look at the depreciation value here, we have $1,000 because of the 10-year useful life of the machine. So if we would go back to the example earlier, that there is a difference usually when it comes to the length of the useful lives that is used. We can say that the shorter the useful life, the bigger or the higher the depreciation value. Therefore, the higher the depreciation value, the higher the tax savings. So if we don't use, if the difference between the useful lives used to compared to the actual useful life, so there will also be a significant difference when it comes to the tax savings. So that's how it affects it, because the tax savings here is used to compute for the net present value of the machine. So to see if the machine should be purchased, we compute for the net present value and we get 12,597.25, which is higher compared to the investment of $10,000. So we get $2,597.25, which is positive. Therefore, the manager may opt to buy the machine. That's how they decide, considering the income tax. Now let's move to the unequal proposal lives. So when there are several proposals, they must be evaluated to see which proposals are profitable and should be considered for investment. The prior capital investment illustrations assume that the alternative proposals had the same useful lives. However, in reality, they won't have the same length of useful lives. Therefore, to make the proposals comparable, the useful lives are adjusted to end at the same time. And that's how it actually complicates, because you still have to make revisions so that the proposals will have the same useful lives. They will end at the same time for them to be comparable. So let's have an example here. A company is considering purchasing a new truck or a new computer network. So in the illustration, we can see that the truck has an expected useful life of 8 years, while the computer network has a useful life of an expected useful life of 5 years. There's a 3-year difference. Now, we would get the net present value of the two proposals. So as you can see, the net present value for the truck is $12,060, while for the computer network, we get $16,805, which is actually higher. But since they have an equal useful lives, the net present value in this illustration are not comparable. So we can compare them based on their net present value since they have an equal useful lives. So what we're going to do is we are going to make adjustments to the truck. So we will revise the truck, and in this illustration, we would assume that the truck will be sold at the end of 5 years. So since it has an expected 8 years useful lives, there would be a residual value. And here it is also computed, it is included in the cash inflow. So now we get 18,640 net present value for the truck, given that we used a 5-year life for the truck proposal. So both proposals will then cover 5 years. Thus, the net present value analysis will be comparable. So if we would look at it as a whole, we can see that earlier we cannot compare the net present values because they have unequal lives. But then when we adjusted the useful life for the truck, we can see that the truck actually has a higher net present value compared to that of the computer network. There is a difference of $1,835 in favor of the truck. Therefore, the truck is a more attractive between the two proposals. Now let's move to lease versus capital investment. So companies have the option to lease or invest, especially on fixed assets like equipment, which would be used for production or services. So the question is, are they going to lease or purchase an asset? So let's look at the advantages of leasing. So when you lease, the company has use of fixed asset without spending large amounts of cash to purchase the asset. Also, the company eliminates the risk of owning an obsolete asset after the contract. The company may deduct the annual payments for income tax purposes. However, a disadvantage of leasing would be that leasing a fixed asset is normally more costly than purchasing the asset. If we would go back to the advantage earlier, we said that we would spend large amount of cash to purchase an asset compared to leasing. But here, we can actually say that leasing a fixed asset is more costly compared to purchasing. Why is that? Well, that is because the lessor or the owner of the asset includes in the rental price not only the cost of owning the asset, but also the profit. So that is why it's more costly to lease a fixed asset. And of course, managers have to consider if if are they going to lease or purchase a new asset. Now, another factor is uncertainty. All capital investment analysis rely on factors that are uncertain. For example, estimates of revenues, expenses, and cash flows are uncertain. This is especially true for long-term capital investments, especially for long-term capital investments. Errors in one or more of the estimates could lead to incorrect decisions. Risk and uncertainty are quite inherent in capital investment analysis. Future is uncertain and involves risk. Risk involves situations in which the probabilities of an event occurring are known, and these probabilities are objectively determined. However, uncertainty is a subjective phenomenon. So we have to consider uncertainties as well. Next is changes in price levels. So interest rates, inflation, and exchange rates are all highly correlated. Price levels normally change as the economy improves or deteriorates. Now, one of the factors we need to see here is the inflation. Inflation refers to a general progressive increase in prices of goods and services in an economy. During inflation, the rate of return on an investment should exceed the rising pricing level. If this is not the case, the cash returned on the investment will be less than expected. Managers need to consider inflation. Also, another is the currency exchange rates. These are the rates that at which currency in another country can be exchanged for US dollars. So when a company has an investment in another country where the local currency is weakening, the return on the investment as expressed in US dollars is adversely impacted. This is because the expected amount of local currency returned on the investment would purchase fewer US dollars. Another factor is qualitative considerations. Qualitative factors refer to non-numeric aspects of the company that are somewhat more intangible but nonetheless affect the potential value of the company. So if a company does not consider qualitative considerations, an acceptable investment proposal could be rejected. So here are some examples of qualitative considerations that may influence capital investment analysis. So managers need to look into the investment proposal's impact on product quality, manufacturing flexibility, employee morale, manufacturing productivity, and even market or strategic opportunities. Like, for example, ownership of a new technology that would give the company a competitive advantage. That would be a qualitative consideration because they're looking for the strategic opportunities here. For morale, the impact on employee morale of adding a break room to the production area. These are qualitative nature. Even the product quality, if there are changes or new investments on machineries or equipment that would affect the product quality, this would have an effect on the satisfaction level of the customers, which is qualitative also. If a large investment of funds is involved, the key decision factors are more likely to be quantitative, since the investing business has a great deal at stake in the decision. However, if the investment of funds is minor, the impact of qualitative factors could play a more important role in the decision. Now, from a branding perspective, in a marketing field, qualitative factors can be particularly important. Proper branding requires high expenditure levels to establish and maintain an aura of quality, which a purely quantitative analysis not justify. Now that's for the factors complicating the capital investment analysis. Now let's go to capital rationing. Capital rationing is the process by which management allocates funds among competing capital investment proposals. So the methods that we learned earlier would be used in the capital rationing. So allocating funds. This would be the end point of the proposals. If there would be funds that would be allocated to push through for the proposals. Now we have here a diagram showing the process of the capital rationing. Now in the topmost part, we can see the alternative proposals, which would be initially screened by establishing minimum standards using the cash payback and the average rate of return methods. So the proposals that survive this screening are further analyzed using the net present value and internal rate of return methods. Then qualitative factors related to each proposal should also be considered throughout the capital rationing process. Like as you can see in the lower part, both the accepted proposals and the earlier rejected proposals go through the qualitative considerations. For example, new equipment might improve the quality of the product and thus increase consumer satisfaction and sales. So we have to consider that in the process. And at the end of the capital rationing process, accepted proposals are ranked and compared with the funds available. The proposals that are selected for funding are included in the capital expenditure budget, while unfunded proposals may be reconsidered if funds later become available. So that's how capital rationing decision process happens. And that would be the end of my discussion. Thank you so much for your time. Thank you